Imagine waking up and you discover that by a direct government mandate, you are legally no longer allowed to serve your biggest customer.
Just boom, wiped out overnight.
Right, literally wiping out nearly half of your top-line revenue. And you didn't underperform, you didn't price yourself out of the market, and, your product didn't fail.
The rules of the game just completely changed.
Exactly. You were just abruptly disqualified from the field. So, welcome to a new deep dive. Today, we are looking at a company that is navigating the immediate aftermath of that exact scenario. We're tearing into the Q3 fiscal 2026 earnings report for DLH Holdings Corp.
Ticker symbol DLHC for anyone following along.
Yep, DLHC. They are a federal government contractor historically rooted in logistics and health services, but now they're going through this forced evolution into digital transformation, cybersecurity, and science research.
And we have a really comprehensive stack of financial documents to parse through today to understand the actual mechanics of this transition.
We get the good stuff.
We really do. The primary sources today are DLH's Q3 earnings presentation, their official press release outlining the quarterly results, and my personal favorite, the highly granular Form 10Q filed with the SEC for the 3 months ended June 30th, 2026.
The 10Q is where all the secrets are.
Oh, absolutely.
Yeah.
Looking at these documents in tandem gives us this rare window into the financial friction of a massive corporate pivot.
So the mission for this deep dive is to look past some genuinely alarming headline numbers. I mean, specifically a 47% drop in revenue and a massive net loss.
It looks really bad on the surface.
It does. But we want to understand the underlying mechanics of a company that's restructuring its entire operational foundation. So, whether you are managing a portfolio of small cap equities or you're just fascinated by the gritty reality of corporate turnarounds, this deep dive is going to show you why judging a company's health purely by its GAAP net income can lead to a completely flawed thesis.
We really have to start with the top line because the income statement presents what looks like just a catastrophic failure. I mean, revenue plummeted to $44.2 million for the quarter.
That is steep.
It's a 46.9% decline from the $83.3 million they generated in the exact same quarter last year.
Wow.
Yeah, you are looking at a near halving of the business in a 12-month window.
Okay, let's unpack this, because losing half your revenue usually signals that your core product is obsolete, or, your sales pipeline is just fundamentally broken.
Usually, yes.
But in the highly regulated world of government contracting, it's more like, well, imagine losing your biggest commercial tenant in a shopping mall. Not because they went bankrupt, but because the city suddenly changed the zoning laws and mandated that only local small businesses could occupy that square footage.
That is a great way to put it.
The demand is still there, but you were just no longer legally permitted to supply it.
What's fascinating here is how that zoning analogy captures the structural risk perfectly. DLH did not lose this massive chunk of business because they failed to deliver.
Right.
They lost it due to federal procurement mandates. Specifically, this revolves around their legacy programs with the Department of Veterans Affairs, or the VA. For years, DLH managed the VA's Consolidated Mail Outpatient Pharmacy programs.
The CMOP contract.
Exactly, the CMOP contracts. This was a massive, highly complex logistics operation responsible for getting prescription medications to veterans all across the country. But the VA recently transitioned those specific CMOP programs to a service-disabled veteran-owned small business set-aside, or SDVOSB.
And the moment that designation hits the contract, a publicly traded mid-sized corporation like DLH is immediately locked out of the prime contractor position.
Completely locked out.
Because the federal government operates with this overarching statutory goal of awarding 23% of all prime contracting dollars to small businesses. When an agency like the VA decides they need to boost their small business metrics, legacy contracts held by mid-tier companies are usually the first targets for reallocation.
Which highlights the notorious mid-tier squeeze in government contracting. DLH is in a really precarious weight class. They have successfully grown out of their small business status.
So they lose all those protections.
Right, they can no longer compete in that protected ecosystem. However, they don't yet have the multi-billion-dollar scale, the massive balance sheets, or frankly, the deep lobbying resources of the top-tier defense primes.
So when the VA decides a legacy logistics contract needs to shift to a service-disabled, veteran-owned small business, a mid-tier player like DLH just has to hand over the keys and walk away.
That's exactly it.
But looking at the timeline in the 10Q, I have to push back a little on how this was modeled.
Okay, what do you mean?
Well, the government doesn't just wake up on a random Tuesday and abruptly cancel a $40 million logistics operation. These transitions are forecasted years in advance, right?
No, absolutely. The draft requests for proposals, the protests, the award periods, it is a very long cycle.
So if management knew this set-aside mandate was coming, why did the revenue impact hit like a sheer cliff in this specific 3-month window rather than, a gradual tapering off?
The documents show that it really comes down to the operational reality of the handover schedule. While the loss of the contract was known and the transition has been a multi-quarter process, DLH was still actively performing services and generating revenue at two major CMOP locations at the very start of this third quarter.
Ah, okay.
Yeah, both of those remaining locations officially. And finally, transition to the new small business contractors during this exact 3-month period ending June 30th.
So Q3 was the final operational cutoff. They were billing for those two locations in April, and by the end of June, the revenue stream was just completely zeroed out. The lingering tail of the contract was severed all at once, which concentrates the entire year-over-year revenue loss into this single reporting period.
And that concentration of revenue loss naturally leads investors to expect a corresponding bloodbath on the bottom line. I mean, when your revenue gets cut in half, the assumption is that the company must be burning through cash just to keep the lights on.
Which makes sense.
Yeah, and the initial headline numbers seem to validate that fear entirely.
Because the headline number is brutal. They reported a GAAP net loss of $16.8 million for the quarter.
Which translates to a loss of $1.16 per share.
Right. And if you look at the comparable quarter last year, they reported a positive net income of $300,000. So a swing from a modest profit to a nearly $17 million loss is enough to trigger a massive sell-off if you stop reading at the top of the press release.
But the cash flow statement tells a completely divergent story from the income statement. Buried just a few lines down in the financial tables, DLH reports generating $4.2 million in positive free cash flow during the exact same quarter.
Wait, really?
Yeah. Furthermore, they posted $3.4 million in adjusted EBITDA, maintaining a rather resilient 7.6% margin.
Wait, stop. How can a company lose almost $17 million in a single quarter, but simultaneously generate over $4 million in positive free cash flow? That math just doesn't add up for a regular person checking their bank account.
If we connect this to the bigger picture, it really showcases the magic or the confusion of non-cash accounting charges. Included in that $16.8 million loss is a $10.4 million valuation allowance.
Recorded against their deferred tax assets, right?
Exactly. Because DLH has had cumulative losses recently, accounting rules literally force them to write down the value of future tax breaks. When a company operates at a loss, the tax code generally allows them to carry those losses forward to offset future taxable income.
Okay, so that future tax reduction has intrinsic value, so it sits on the balance sheet as an asset.
Right. But accounting standards require strict, objective evidence to keep that asset on the books. You have to prove that it is more likely than not that you will actually generate enough future profit to utilize those tax shields.
And because DLH has experienced significant cumulative GAAP losses over the past few years, largely driven by amortizing past acquisitions and winding down these exact VA contracts, the auditors are forced to look at the historical data.
Regardless of management's optimism about the future.
Right. The trailing metrics compel them to write down the value of those deferred tax assets today.
The creation of that $10.4 million valuation allowance hits the income statement immediately as a massive tax expense, which artificially inflates the net loss.
But not a single dollar actually left the corporate treasury.
Not one. It is entirely a paper write-down.
This is exactly why retail investors get caught off guard by turnaround stories. If you screen stocks based purely on trailing GAAP net income, DLH looks like a company in severe financial distress.
Oh, absolutely.
But when you strip out the non-cash valuation allowances and the depreciation, you see a core operation that is actually still pulling in strong receivables and generating positive free cash flow. The enterprise is producing capital, not consuming it.
Which is huge. And the most critical piece of analysis for a company in this position is evaluating how management deploys that newly generated capital. When your legacy revenue base is structurally eliminated, capital allocation becomes a matter of survival.
And the 10Q outlines exactly where that $4.2 million in free cash flow went. They didn't stockpile it, and they didn't attempt to acquire replacement revenue. They aggressively swept the cash against their principal debt balance.
Which was definitely the right move.
Yeah, they reduced their outstanding debt by roughly $4 million sequentially in Q3 alone, bringing the total debt load down to $128.7 million.
That actually marks their lowest debt level since December 2022. And the earnings presentation notes they are now nearly 3 quarters ahead of schedule on their mandatory debt repayment timeline.
Here's where it gets really interesting, because I would argue that accelerating debt repayment in this specific macro environment is the only logical move. Their secured term loan is floating rate, tied to SOFR plus a 4.1% margin.
Ouch.
Yeah. In a world where the risk-free rate is hovering around 5%, they're paying roughly 9% on a massive chunk of leverage. That is incredibly expensive capital. By paying down principal ahead of schedule, they are permanently destroying future interest expense, which effectively acts as a compounding boost to future free cash flow.
The debt reduction is vital, but, you cannot shrink your way to prosperity purely through interest savings. When a business loses 47% of its top line, the immediate threat is that the fixed corporate overhead, the general and administrative expenses, will just completely vaporize the remaining operating margins.
Which is why the line item for indirect cost reduction actions is so revealing.
Yeah.
The documents show management slashed roughly $3.3 million from their G&A expenses this quarter. That tells me they aren't treating this revenue drop as a temporary dip. They aren't hoping to quickly win back replacement contracts to fill the existing corporate infrastructure.
Right. They are fundamentally and permanently shrinking the back office to match the reality of their new, smaller revenue base. Right-sizing the corporate infrastructure is notoriously difficult to execute without disrupting ongoing operations. But by proactively pulling $3.3 million out of their indirect costs, they are defending that 7.6% adjusted EBITDA margin,
They are establishing a new, lower baseline for profitability.
ensuring that even as a smaller entity, they remain highly cash generative.
So the timeline of the turnaround becomes really clear. Q3 was the inflection point. The legacy VA contracts are entirely off the books. They absorbed the brutal non-cash valuation allowances to reset the balance sheet. They aggressively cut overhead to protect the margins. And they are sweeping all available cash to deleverage a high-cost credit facility.
The slate is mathematically wiped clean.
So the question now is, what exactly is the growth engine for this restructured entity?
The answer to that lies in the strategic leadership transition that occurred at the end of the quarter. Following the retirement of Zach Parker, the board appointed Katherine John Bull as the new president and chief executive officer, alongside Steve Arojo stepping up as the chief financial officer.
And John Bull's commentary in the press release draws a very hard line in the sand regarding the company's identity. She stated that beginning in Q4, DLH's revenue will be generated entirely by technology-powered solutions. So they are formally abandoning the legacy logistics and mail-order pharmacy identity, completely pivoting the enterprise toward digital transformation and cybersecurity for federal agencies.
The strategic shift from physical logistics to digital infrastructure is immense. To prove this isn't just corporate rebranding, the CEO highlighted a significant recent contract win that perfectly illustrates the new model. DLH secured a multiple award contract with a formidable new customer, the U.S. Navy's Naval Air Systems Command, commonly known as NAVAIR.
The NAVAIR contract is a MAC IDIQ, which stands for Multiple Award Contract, Indefinite Delivery, Indefinite Quantity. This is essentially a hunting license in the federal procurement space, right?
That's a great way to describe it.
DLH isn't guaranteed a specific dollar amount of revenue on day one. Instead, the Navy has vetted their technical capabilities and granted them a seat at a very exclusive table. They now have the authorization to bid against a limited pool of approved vendors for specific, highly technical task orders over the coming years.
The nature of those task orders is what separates the new DLH from the old. At NAVAIR, they will be competing to provide logistics, IT services, systems modernization, and crucially, DevSecOps pipelines.
Wow, DevSecOps.
Yeah, which involves integrating security directly into the software development and deployment lifecycle. They will be securing and modernizing the underlying code and digital infrastructure that supports naval aviation readiness.
That requires an entirely different talent profile. I mean, managing the physical distribution of prescription bottles through the VA requires logistics expertise and operational efficiency. But building DevSecOps pipelines for the Department of Defense, that requires elite software engineers, cybersecurity architects, and personnel with high-level security clearances.
It's a completely different ballgame.
The barrier to entry in the DoD tech space is incredibly steep.
Which is exactly why this IDIQ award is strategically critical.
Yeah.
If you look at DLH's year-to-date revenue breakdown, the vast majority, 57.1%, still comes from civilian health and human services agencies.
Right.
The Department of Defense currently represents only 12% of their total revenue. The Navarre contract provides the wedge they need to diversify their client base and scale their presence in the high-margin, high-growth defense technology sector.
So what does this all mean for the fundamental valuation of the company? We started by looking at a financial report that seemed to indicate systemic failure, a nearly 50% drop in quarterly revenue, and a massive net loss.
Yep.
But when you strip away the accounting noise, you see a company that just successfully executed a highly complex voluntary restructuring.
They absorbed the structural loss of the small business set-asides, took the necessary JAP write-downs, ruthlessly cut their operating expenses, and accelerated their debt paydown.
They traded a massive, low-margin legacy logistics contract for a leaner, more agile corporate structure focused entirely on high-margin tech solutions.
It is a textbook example of addition by subtraction. By shrinking the top line and cutting the overhead, they have positioned themselves to be a pure-play federal IT and cyber contractor. But, pivoting to a tech-only model in the defense sector introduces a new set of capital constraints.
Which raises an important question based on the strategic roadmap outlined in the sources. DLH currently boasts a very healthy backlog of $408.5 million.
That's a lot of potential revenue.
It represents future potential revenue from signed contracts and unexercised options. But as we discussed with the Navy IDIQ, a massive chunk of that future potential requires actually winning individual task orders in a hyper-competitive environment.
Exactly. To win complex cybersecurity and DevSecOps contracts against entrenched defense primes, you need to recruit, hire, and retain top-tier technical talent. And in the current market, AI specialists and cleared cyber engineers command a massive premium.
They are not cheap.
Not at all. The central tension moving forward is capital allocation. Management is currently aggressively sweeping nearly all of their $4.2 million in free cash flow to service that $128 million debt load.
Right.
The aggressive deleveraging is a smart defensive play, but it begs the question, will the company have enough free capital left over to invest aggressively in the cutting-edge talent, the advanced technology, and the costly proposal development required to actually convert that $400 million backlog into recognized revenue?
They possess the hunting license for the DoD, but they have to decide if they are going to use their cash to pay off the mortgage or use it to buy the specialized gear needed to actually win the hunt.
That is the precarious tightrope management must walk as they move into fiscal 2027.
Do you prioritize defensive debt reduction, or do you pivot to aggressive reinvestment to fuel the tech transition? The answer to that question will ultimately dictate the success or failure of this entire corporate rebirth. We will definitely be closely watching the cash flow statement next quarter to see exactly where they place their bets.
It's going to be fascinating to watch unfold.
Absolutely. Thank you for diving deep with us today. And if you want to stay ahead of the market, be sure to follow the show for our daily earnings coverage. See you next time.